You're everywhere, man.
That's you did this.
¿Cómo están? How are you? Good to see you. You well? All right. All of us. How are you? Nice to meet you. ¿Cómo está? Good to see you. Good to see you again. Yeah. Let's get this show on the road. How you doing? Good to see you. Good afternoon. Buenos dias. How's everybody doing? Yeah. I was asked to give a shout out to the overflow room, all my people from SAIU who couldn't get in. I went to go say hi to them earlier today. It's great to have you all here. I just want to say before I begin, I'm going to have to leave halfway through our hearing, but our Deputy Commissioner, Janice Rocco, is here, who will take over the helm and continue to make sure we continue with the hearing and listen to all the comments and questions. But we're going to have our comment period before I leave. I want to hear from the community who's here. And thank you for taking the time to being here. This public hearing, where we'll be discussing the information regarding prescription drug prices and large group health insurance annual premium increases. Both of these topics are of great concern to me and to many of you who are here today. We know that the rising cost of premiums make it harder to make health affordable for our everyday working Californians. And we are here to drill down on that and give us and utilize the data that we've been able to capture to find out why this is happening and why this is happening here in California. So, as you know, the majority of Californians with health insurance coverage, other than Medicare, receive their coverage through large employers with more than 100 employees. As large group health insurance costs continue to rise, California's working people often find that whatever pay increases you receive from employers disappear because you're paying for the cost of health insurance. And we know that health insurance premiums or out-of-pocket costs sharing increases such as higher deductibles or copays fully exacerbate this problem. And today's hearing, you're going to hear about many of the factors that contribute to these premium increases. I want to take a moment to thank Senator Mark Leno from San Francisco with SB 546. The Department of Insurance now receives aggregated data from each health insurer that sells large group coverage. The data indicates what the average premium increases were from large employer coverage in the prior year of each insurer. The department has, in recent years, started to receive this aggregated large group premium information from health insurers, but only after the rate increases have already gone into effect. So we do not receive full-blown rate filings with specific information regarding premium increases for specific health insurance products or plans the way that we do with health insurance coverage sold to individuals, families, or small employers. So for the individual and small employer health insurance products, the Department of Insurance receives much more detailed data about medical claim costs, administrative costs, and profits before any rate increase can go into effect. Our actuaries and professional staff review the data in order to make a determination about whether the proposed rate increase for individual or small employer coverage is unreasonable. If the department finds that the rate increases to be unreasonable, as you know, we request that the health insurer lower the rate before the increase is implemented. I'll give you a quick example of that happening recently. Anthem is increasing rates for the individual market on April 1st, and the department found their proposed rate increase to be unreasonable, and we asked them that the rate increase be lowered. Anthem agreed to lower the rate increase by approximately 3%, which will save consumers approximately $10 million. Current law does not give the department this rate review authority for large employer health insurance coverage, but I have to say that my good friend from San Jose, Senator Carra, just introduced AB 731, which would give the Department of Insurance and the Department of Managed Care this review authority over health coverage sold to large employers. So I hope that we all can back Senator Carra. This is critical information that we need. And Today, again, I want to thank former Senator Ed Hernandez for SB 17. For the first time, insurers recently submitted to the department cost information regarding prescription drug costs. We can see now from the data that ever-increasing cost of prescription drugs are a significant driver of health insurance premiums, making up 13.6% of premium costs. The cost of brand-name oral prescription drugs rose by more than 9% per year between 2008 and 2016, while the annual cost of injectable drugs rose by more than 15%. The price of insulin is vital to our health, and the very lives of those with diabetes. That doubled nationally between 2012 and 2016. Specialty drugs are especially costly. Current therapies for hemophilia are priced between $580,000 to $800,000 per year. Just this past January, nearly 30 drug makers announced their intention to increase prices further. We will hear more about this data from our speakers today. I want to just again thank you for being here. And as many of you heard, Governor Newsom, in his first act as governor, is taking action regarding prescription drug costs by signing an executive order that requires the Department of General Services to develop a list of prescription drugs that could be prioritized for bulk purchasing or renegotiating of pricing with the manufacturers. It also calls the Department of Health Care Services to transition pharmacy services from Medi-Cal managed care to fee-for-service to create significant negotiating leverage for us as Californians. It also calls on DGS to develop a framework for enabling private purchases such as insurers, employers, and union trusts to opt in to a state purchasing program in order to save money on drug costs. So this is a tremendous, tremendous achievement. We need to make sure we see it through, and we want to thank the governor for implementing what you would call essentially a single-payer system for prescription drug prices, which gets us on our way to stabilizing the cost of these important medications for every Californian. The Department of Insurance is now a part of the California Pharmaceutical Collaborative that is working to gather information and make recommendations to the governor about how to implement some of these proposals to lower costs of prescription drugs. There are already a number of bills that were introduced this year in the California legislature dealing with prescription drug coverage, as well as bills in Congress. I will, in coordination with our governor, support efforts at the state and national level to improve access to vital medicines at a more reasonable cost. I want to thank you again for being here. Understand that we are committed for the long haul to ensure that we continue to provide strategies, whether it be at the agency level, whether it's at the legislative level, to make sure that we continue to fight these outrageous cost increases in our prescription drugs. So now I want to take a moment for you to hear the information regarding our prescription drugs. Today we have the department's Chief Health Actuary, Lam Brown, Senior Health Policy Attorney, Bruce Hinsey, followed by a presentation from SEIU UHW regarding the harsh impacts of premium increases on our working people. After the presentations, I look forward to comments from members of the public regarding these important issues. Thank you for being here. Take it away, Lam.
Thank you, Commissioner. If you can hear me. For the first part of our presentation, we will provide summary findings analyzing prescription drug information provided by health insurers. 9 health insurers provided information that we have brought together and will summarize for you today. I want to point out one of the insurers that you will see there is Kaiser Permanente Insurance Company. That is a separate insurance company affiliated with the larger Kaiser organization. But Kaiser Permanente Insurance Company, the entity that we regulate, sells a PPO product in areas where the Kaiser organization doesn't otherwise sell coverage. I'd like to discuss briefly about what the insurers reported in compliance with the requirements of Senate Bill 17 which was enacted in 2017. It required that insurers report information regarding outpatient, generic, brand name, and specialty drugs, and I'll tell you what those are, in each of the 3 categories, and these categories were specified in the statute. The 25 most frequently prescribed outpatient drugs, the 25 most costly drugs by total annual plan spending. This is the measure that was specified in statute, not other measures such as the cost for a 30-day supply. Instead, this is the 25 most costly by total annual plan spending, including cost sharing, such as co-pays or deductibles. We will be presenting summary findings regarding those categories today. SB 17 also required that the insurers provide information regarding the 25 drugs with the highest year-over-year increase. Because this is the first year that data was provided in response to SB 17, we are not summarizing the year-over-year increase in this presentation, in part because the information tends to primarily highlight new drugs or drugs that came to market next year. However, if you want to read all about it, and all the data that you will hear about today in detail, our full report, including summary data for all categories, is available on the department's website, which is www.insurance.ca.gov. In the search field in the upper right of the website, type in premium drug prescription impact into the search box, and that will take you to a link that will enable you to print out this report. Also, the raw data submitted by each insurer is also available on our rate review page of our website. I'll provide a link to that later in the presentation. That's okay. So, let me talk about some definitions. A generic drug is a drug that is chemically and biologically equivalent to an already marketed brand name drug. So it's the same in dosage, form, safety, strength, route of administration. A brand name drug is a medication that's protected by a patent. And you'll hear during my presentation today that the generic drugs have difficult names, which I will strive to say. Brand name drugs have short and snappy names. That's the difference. Specialty drug, this is a definition that is a little more complex than generic and brand. Specialty drugs are drugs with a monthly cost that exceeds the specialty drug threshold for specialty drugs in the Medicare Part D program. In 2018, that amount was $670 for a 1-month supply. Now, many of the names of these specialty drugs will be familiar to you because millions of dollars have been spent in direct-to-consumer advertising to make sure that you know them. So you'll remember some of them when you hear them. And now, Lan Brown, our Chief Health Actuary, will discuss specific information. And she'd like to have the microphone for that purpose.
Hello, everyone. Thank you so much for coming. And happy Pi Day. So we're going to go into some of the details, and we have summarized information to show what we received under SB 17. So the individual submissions from each insurance company is confidential, but we're allowed to share once we aggregate the information. So the first one you see is we dissect into the usage in 2 ways. One is by number of prescriptions, and we can see under the by number of prescriptions, the generic is a big chunk of what the drug spend is. But that's the green part of the pie. And then if you look at the right-hand side, the cost for generic is 21% of the total cost. On the other extreme is the specialty drug, which is only 3% of all the prescriptions is specialty, but the cost is 52%. So brand is somewhere in the middle. Not surprising. It's just still surprise. I guess it's good to see the magnitude of the differences in how efficient generic drug is and how costly specialty is in comparison. Okay. So this one shows the cost in relation to premiums for the 2017 calendar year. So not surprisingly, the most of the cost on the medical premium side is for the medical-related expenses. Drug is 14%, and administration and other things is the rest, about 12%. This one shows the member cost sharing per script for 2017. So for generic, the percent is the highest at 33%, and the percent is the lowest for specialty. But if you look at the table underneath, it tells you the dollar amount, even though the generic is a higher percent, but the member per script is only paying less than $10. For specialty, because the drug is so expensive per script, the member cost sharing is $133 on average that the member pays.
And I apologize for my poor skills with the clicker, but we'll be revisiting those slides in a moment because I got them out of order. So I apologize for that. This slide, slide 10, shows that in 2017, manufacturer drug rebates for California health insurers accounted for approximately $186.2 million, or approximately 17.17% of the $105 billion spent by health insurers on prescription drugs. Now, you might inquire, it sounds like a good thing. Rebates are coming back to the health insurance company.
So are these rebates actually reducing the consumer prices?
Not necessarily. The role of these rebates in the pharmaceutical pricing system is controversial. The concerns raised by the rebates include the fact that the price set by the manufacturer anticipates the rebates. It's kind of like if you have an $80 product and I offer to sell it to you for $100 and give you $20 back. Well, that rebate really isn't giving you a significantly lower price if I could have just sold it to you for $80. Rebating also encourages the use of more expensive, higher margin brand and specialty drugs at the expense of generic drugs. Rebating can also affect the insurer's prescription drug formulary tier placement. You'll recall in your insurance, most insurance has typically 4 tiers of preferred generics, non-preferred generics, and preferred brand, non-preferred brand, and specialty drugs. The placement of where a drug falls on those tiers has a direct impact on your out-of-pocket expenses in terms of the cost sharing, the copay or the deductible that you have to pay. The rebating can affect the insurer's decisions regarding placement on the drug formulary tier, as rebates enable an insurer to place a brand drug on a higher tier, such as tier 2, with lower cost sharing for the consumer, while the generic can be placed on a more expensive tier, discouraging its use. Commissioner, we recently had an experience with one insurer regarding the drug buprenorphine, which is hard to say when your mouth is dry. It's a medication that is used in medically assisted opioid disorder treatment. Because of some rebate considerations, this insurer placed the brand on the formulary, but kept the generic off the formulary. And your department struggled with his insurer about that. Thanks for the water. I actually do have tea, but I wanted to speak to you. I'm going to enjoy my tea while Lan reminds us about slide 11, which showed the member cost sharing per prescription. I'm going to sit back and enjoy my drink.
I was obviously ahead of myself. So anyway, this is, I talk about these numbers, just showing the member cost sharing, and the specialty, just want to point out the specialty cost sharing at per script is $133 a month that member pay on average. Of course, I'm sure some of you guys have plans that require you to pay more. So the next one, if you remember, what part of the submission is talking about the 25 most frequently prescribed medicines, drugs that each insurer has to submit. So we consolidated that information, and then we look at out of the 25 most frequent prescribed drugs, how does it compare both as number of prescriptions and cost compared to all the drugs spent. So the left side of the pie basically was saying that 40%, the 75 drugs, 25 generics, 25 brand, and 25 specialty, altogether 75 drugs, is about 40% of the total prescription that of all the drug uses. 60% is the other drugs, could be generic, brand, and specialty. And then amongst the 40%, 32% is generic, and 7% is brand, and 1% is specialty. So on the cost side of that 75 drugs, it's about 35% of the total cost. So thank you, Bruce. Bruce is going to give us some interesting examples.
Now I'd like to provide you with some detail about our findings and give the opportunity to learn about some prescription drugs. The next series of slides discusses the top 6 drugs in the various categories. We're presenting this detail because it reveals some interesting patterns, and it highlights some drugs that have a significant impact on healthcare costs. Now this slide 14, shows the most frequently prescribed generic drugs. Number 1, perhaps unsurprising, is the cholesterol-lowering agent atorvastatin, which many of you will know as Lipitor. Keep your cholesterol level down to decrease your risk of heart attack and stroke. Number 2 is levothyroxine, which has the brand name of Synthroid. That treats hypothyroidism, if your thyroid gland isn't secreting enough hormone. You'll see this drug again on the brand name list, and we'll talk about it then. Number 3 is lisinopril, which controls high blood pressure. And the number 4 drug on this slide 15 is the most frequently prescribed, fourth most frequently prescribed generic drug is amlodipine, which treats hypertension. And this is probably someone texting me saying I'm saying something wrong. Unsurprisingly, 3 of the top 6 generic drugs treat cardiovascular disease. Number 5 and number 6 among the generics are 2 familiar antibiotics, azithromycin and amoxicillin. And I should do this, I'm so enchanted by what we're saying. And I'd like to thank the azithromycin and amoxicillin fans who helped me bring this slide up. Now, slide 16 shows, interestingly, make sure we're on it, that Synthroid is also the most frequently prescribed brand drug. Now, there are at least 4 reasons that might account for this finding. One, of course, may be data entry errors in this first year of submission by the insurance companies. We're going to be working with them over the next year prior to their next SB 17 submission due October 1st to make sure that they've been coding this information correctly. However, it's also possible that physicians may be writing Phyllis-prescribed prescriptions for the brand drug, which requires that the drug be filled as the brand name. Now, while the Business and Professions Code allows pharmacists to make substitutions of generic for brand drugs, this is not mandatory. Also, the pharmacists can't substitute the generic if the generic won't cost the insured less, the insured person less. Also, as I mentioned before, brand manufacturers have rebates that can result in better placement of the brand than the generic on the formulary. And remember, these rebates go back to the insurer, not directly to the consumer. So let me turn my phone off. The brand can be placed on tier 2 and the generic on tier 3, as I mentioned before with some of the other drugs, such as buprenorphine. And this can result in, and that's Siri trying to talk to me while I'm trying to turn my phone off. Excuse me, I'm sorry. This sort of tiering is is permitted under the drug tier definition for individual and small group markets, because any drug that can be placed on tier 3 if there is a therapeutic alternative at a lower tier. Slide 15 also shows that the number 2 and number 3 most frequently prescribed brand drugs are 2 brands of albuterol, a bronchodilator used in the treatment of asthma and chronic obstructive pulmonary disease, or COPD. Those are the brand name ProAir and Ventolin. The frequency of those prescriptions shows the prevalence of those respiratory conditions. Slide 17 is the most frequent brand drugs 4 through 6. The 4th most frequently prescribed brand drugs is dexamphetamine, which is Vyvanase, which is used in treatment of attention deficit hyperactivity disorder, as well as binge eating disorder. In a later slide, we will see that this drug is also the most costly in total annual prescription drug spending. The 5th and 6th most frequently prescribed brand drugs are 2 contraceptive agents, one a combination oral agent, and one a contraceptive in the form of a vaginal ring known as NuvaRing. Slide 18 are the most frequently frequently prescribed specialty drugs. We're not there yet. The most frequently prescribed specialty drug is the combination emtricitabine. Let me take another sip. And tenofovir under the brand name Truvada. This drug treats HIV infection, but importantly, can also prevent infection when used for pre-exposure prophylaxis or PrEP by at-risk persons who are not HIV infected. So access to this drug is critical. As you'll find out later, it's also the 3rd most costly drug in terms of overall annual prescription drug spending.
And PrEP is actually preventative.
Right.
Right.
It is preventative.
So it's not necessarily for at-risk people. It's people that are trying to prevent the infection of HIV.
It's trying to prevent for those who are not HIV infected.
Right.
And it's a vital drug. The 2nd most frequently prescribed specialty drug is it's Humira. Thank you. It's adalimumab. I wanted to mention that because the MAB suffix indicates it's a monoclonal antibody. So there is meaning to the generics. And it's used in the treatment of autoimmune diseases such as arthritis and plaque psoriasis and Crohn's disease. Now, the 3rd most frequently prescribed specialty drugs, and one of particular interest to me, is insulin Lispro, sold under the brand name Humalog. It's a synthetic insulin analog used for the treatment of diabetes. Now, 40 years ago, I was a registered nurse using synthetic human insulin in a hospital. It was relatively reasonably priced. Humalog has been modified so that it has benefits for the consumer, but it is much more expensive, and its price has been going up significantly, as Commissioner Lara mentioned. Slide 19 are the 4 through 6 most frequently prescribed specialty drugs. The 4th and 6th are drugs also used in the treatment of adult diabetes, type 2 diabetes. They are not insulin. They increase the effect of your natural insulin. Now, slide 20 is information that Lan will provide, if I give her the microphone.
I just want to point out, so this is the chart about the 25 most costly drugs. So it'll be 75 drugs in total, 25 generics, 25 brand, and 25 specialty. So I just want to bring attention to the right side of the pie chart on the blue portion, and that's saying that the 25 most costly specialty drugs that contribute 27% of the total drug spend, which is quite astonishing anyway. So I'll hand it back to Bruce.
And in the interest of time, I would like to move through the next slides quite quickly, and so that we can move more quickly to Joan Allen and her presentation on behalf of SEIU. These are the most costly drugs, and we're starting in the most costly generics, and I'm just going to scroll through them quickly. That's the second tier of most costly generics. That's the most costly brand. You'll see some familiar names that we already discussed. Here's the next tier of most costly brand. Because of the advertising, I'll have to point out Januvia and Evocana are on those ones. Here's the most costly specialty. Again, Humira is on that. And the second tier of most costly specialties. So, having accomplished that, I'd like to invite Joan Allen of SEIU to come and provide us with a presentation.
Good afternoon, Commissioner Lara, department staff. Hi, good to see you in this new role.
All right. Well, thank you.
Yeah. Thank you for the opportunity to speak. My name is Joan Allen with SEIU United Healthcare Workers. Here today to talk about the underlying drivers of group health insurance rates, particularly a few cost drivers that we've identified that do not benefit either patient care or access to care for enrollees. Next slide, please. It's like in the conversion of slides, things may have gotten a little warm. Okay.
Technology.
We'll sort it. As healthcare workers, we want all Californians to have access to affordable, quality health care. However, workers and their families are increasingly bearing the brunt of, and we're on the next slide, yeah, that one. Increasingly bearing the brunt of rising premiums. Over the last several years, as premiums have increased, workers' share has increased faster in terms of premiums as well as deductibles, with now 85% of workers now having a deductible on their group health insurance plan. Out-of-pocket costs are also increasing faster than inflation, faster than workers' wages, particularly as relevant to the SB 17 presentation we've heard on prescription drugs. Rising health insurance costs, as you pointed out in your opening remarks, are also a major issue during bargaining. Every time we go to the table, health insurance costs are an issue, and we've heard this week as well at the DMHC hearing on Tuesday from other unions where workers' wages and raises are just being chewed up as health insurance rates rise, and it's becoming harder and harder to stay ahead of inflation and maintain the good middle class lifestyle that we value here in California as union workers and that we want for all workers.
And are you seeing, as this is occurring, are we increasing the amount of services we're providing, or are we decreasing? How is that impacting the quality of care? Are you assuming if we're paying more, that would increase the quality and the services available?
In general, utilization is not going up. Most of this is being driven by increases on the price side, not in terms of utilization. And that has been true over the past 20 years and becoming increasingly more true as we focus more on preventative services. There is some ability to avoid some of those higher cost services down the road, and that means that these prices going up more and more is driven on the price side, and particularly, as we see on this slide, by factors that are on the provider control. So here in California, the bulk of the premium dollar is spent on hospital and physician clinical services, but not all of that is actually going toward improving patient care. Next slide. So three things that I want to focus on today, where we're seeing a real impact in premium costs that are not benefiting patients or providing additional access. And that is increasing market consolidation and manipulation, undue financial interest by providers, and then also a lack of transparency in the system that's making it more and more difficult for advocates and regulators and purchasers to really understand the underlying market dynamics. To illustrate that, I have a couple of case studies. First, a case study on Kaiser Permanente, and then on outpatient dialysis clinics, an issue I know you're familiar with. To start with, so Kaiser Permanente controls 59% of California's large group market. However, they have consistently high prices and high reserves as part of that market control. But they lack some of the transparency into what their cost drivers are that other systems have. Next slide, please. So almost a quarter of Californians are enrolled in Kaiser, which really gives Kaiser a shocking level of market control, particularly since Kaiser is not geographically distributed evenly. Means that there are pockets of California where Kaiser really has tremendous market power. In the large group market that we're discussing today, the bulk of Kaiser's enrollees are on the DMHC side, but between the DMHC product and the CDI product together, it is more than 5 million enrollees. And that share has grown steadily over the last several years as Kaiser really has focused on that large group market. Next slide, please. Unfortunately, Kaiser is starting to act less like a nonprofit health system and more like a for-profit. We've seen high profits over the last several years, generally in the $2 to $3 billion range, with those prices being driven by the underlying price structure instead of by utilization. As you were asking earlier, when plans are reporting what is driving their prices, they're reporting both on the utilization side and on the price side. Kaiser, unique among the plans, particularly for their larger DMHC product, unique among the plans is reporting that their entire rate increase is coming on the price side and none on the utilization side. And that's been true for the last few years. And we would question, given the lack of transparency, we would challenge Kaiser to do a better job of explaining where that's coming from. Despite that substantial profit level, Kaiser is still raising their rates. And additionally, competitors, purchasers, and regulators have questioned Kaiser's rates, particularly in Northern California, where they have been called out for shadow pricing, particularly of Sutter Health, that as competitors such as Sutter raise their prices, Kaiser's prices tend to track. And that is not fully investigated and understood within the current regulatory framework. Also, in terms of looking more like a for-profit these days, Kaiser's executive compensation has been increasing considerably, with now more than 30 Kaiser executives making over $1 million a year, and Kaiser's CEO Bernard Tyson making more than $10 million a year in 2016. Next slide, please. Kaiser's also holding questionably high levels of reserves. DMHC requires plans to hold a minimum level of reserves tangible net equity, which is calculated from total assets, total liabilities, intangible assets, and other unsecured obligations. And that that ends up looking like the largest of $1 million or a percent of premium revenues or a percent of healthcare expenses. So currently, as DMHC calculates it, Kaiser's required to have $2.1 billion of tangible net equity on hand. They have $31.5 billion. And that has been increasing rapidly over the last several years. This far outpaces both the amount and growth rate of other health plans in California. And while Kaiser's integrated structure explains part of this, it doesn't explain all of it. And again, additional transparency into this driver would be greatly appreciated. This has been called into question by purchasers and regulators. For example, in Colorado, regulators in 2008 required Kaiser to spend down their cash reserves by $155 million in Colorado, giving premium credits and spending on clinics in medically underserved areas, and also required Kaiser to essentially repatriate cash that it was holding here at its parent company in California.
Joan, what have been the discussions in terms of reasoning behind such big, funds?
Part of it, as I said, the integrated nature of Kaiser, some of that high tangible net equity is Kaiser's hospitals, but that does not explain the rapid growth. And really starting in 2013, Kaiser changed some calculations on things like its pension liability that caused a spike in tangible net equity, changed other reporting, and also $2 to $3 billion in profit each year means that is going to increase their bank account over time. And so the question of when do those reserves become excessive is one that has been raised by purchasers and could definitely be raised by regulators as well. And next slide, please. There are also several corporate practices by Kaiser that make it more difficult for purchasers and regulators to determine the appropriateness of Kaiser's rate structure because Kaiser is less transparent than other healthcare systems in California. Kaiser's lack of transparency around the financial relationship with the Permanente groups, its integrated medical groups, is a good example of this. Kaiser's essentially three entities: its health plans, its hospitals, and the Permanente groups. Unlike most integrated systems, Sutter, Dignity here in California, that use a nonprofit medical foundation model to incorporate their physicians and their non-hospital clinics into the business, Kaiser's Permanente groups are for-profit. And that just results in substantially less disclosure about the financial relationship between those entities than you'd see in a nonprofit structure. We have very little data about how much money flows from Kaiser to the Permanente groups. There's one piece of data that we have is in Kaiser's financial reports that last year they paid $38 billion for primary and specialty physician services. That's a national number, so if we do an approximate here for California, it would be almost $30 billion in money without any transparency paid to the Permanente groups. And so we don't know the profit that's being generated by the Permanente groups. We don't know the executive compensation on that side of the business. And by comparison to a nonprofit medical foundation, it really is a black box there, which makes it harder for purchasers and regulators to understand Kaiser's rate structure as to whether that is an appropriate compensation. Next slide, please. There are also a couple of places where Kaiser just reports less data to the state. One of those is to OSHPD, where hospitals report financial and utilization data. Kaiser has various exemptions that allow them to report, instead of for every hospital, they report a Northern California number and a Southern California number. And so if you're trying to do an analysis of a particular market and hospital cost drivers within that market, it gets very difficult without being able to include Kaiser, which has a huge percentage of California's healthcare market. Next slide. Kaiser also has exemptions within reporting on insurance rate drivers. I know that for their PPO product regulated by CDI, they primarily don't use that exemption. But on the DMHC side, having almost 5 million DMHC regulated members not reporting at the same level of data makes it very difficult to do comparisons and to do an entire picture of the insurance market for California. And we see all of the time studies of the health insurance market or of the hospital market that have an asterisk at the bottom that says does not include Kaiser. And so we would look to greater transparency from
Why
Kaiser.
Is that?
They've said over the years that they can't calculate data the same way that other hospitals or other health insurance plans can, that the way that their integrated model works means that they don't have the same data. I would challenge that Kaiser is a company that can produce data on pretty much anything, and that this has been a choice to not produce this data.
Joan, would that be a regulatory change, or would we need legislation? Are they exempt out of reporting policies?
They actually do have statutory exemptions, and there is a bill that Dr. Pan is moving this year, SB 343, that we actually is a companion bill to AB 731, and those are somewhat linked, but would mean that Kaiser would no longer have those exemptions and would have to report data along with all of the other health plans.
Thank you.
And next slide, please. Great. So just in summary, Kaiser's market power really is allowing them to act in ways that require more transparency, require more investigation, and currently those exemptions do not allow for us to be able to see fully into Kaiser's business model. Next, please. Second case study is outpatient dialysis clinics, where we see the same market power, market manipulation, undue financial interest, and lack of transparency that we see with Kaiser, just in a little bit different provider-centric way. Next slide, please. As you know, 69% of dialysis clinics in California are controlled by two companies. DaVita and Fresenius are both multinational, for-profit companies, not based here in California. And these companies have grown rapidly in recent years, particularly on the DMHC side, where there are network adequacy requirements. DaVita and Fresenius are must-haves in networks in order to issue an HMO product, which means that insurance companies have very little ability to negotiate. This generates very high commercial rates, 3 to 4 times the cost of actually providing care. Next slide, please. That has meant rapidly growing profit. And in the interests of time, we'll say that California's dialysis clinics are making approximately an 18% profit margin. This is much higher than the normal profit margins enjoyed by hospitals, nursing homes, other parts of the healthcare industry. Next slide. And part of this is being driven by a really interesting scheme where the dialysis companies, particularly DaVita and Fresenius, the large companies, are giving hundreds of millions of dollars a year to a nonprofit called the American Kidney Fund. The American Kidney Fund then turns around and uses those hundreds of millions of dollars to buy health insurance for dialysis patients. And much the same as you see with drug rebates, that sounds like a really good thing until you unpack that it's causing giant losses for the health insurance companies because those patients would otherwise be on Medicare, Medi-Cal, or would be dual eligible. So one patient steered from a commercial onto a commercial plan from Medicare or Medi-Cal can generate $250,000 in underwriting losses for a plan. That rapidly becomes unsustainable, and financial analysts, stock analysts that look at the risk pool have flagged this as something that can easily damage the risk pool. Here in California, we have seen this with DaVita having said that this practice is generating up to $50 billion in profit for them just here in California. And they've disclosed to their stockholders that this is generating upwards of $500 million in profit for them off of just a few thousand patients. Given that all of the rest of us who pay health insurance, who pay for health insurance, end up bearing the brunt of this profit shifting, we are supporting AB 290 this year, which is Dr. Wood's bill, to remove the financial interest for dialysis clinics and other providers to move their patients onto commercial plans who would otherwise be on a Medicare or Medi-Cal plan. Next slide, please. And in terms of lack of transparency, the dialysis industry doesn't disclose to patients often the harm that could happen to those patients by moving them onto a commercial plan, whether it's additional cost sharing or other treatment options that would be better for them clinically or financially. The dialysis companies also don't disclose to the health insurance plans that they are engaging in this practice, and go so far as to try to hide it by giving patients debit cards instead of paying the premiums directly through the American Kidney Fund. And lastly, dialysis clinics often don't disclose the financial relationship between the nephrologist medical directors and the companies themselves. In many cases, the medical director has a financial interest in the clinic and is the referring physician to that clinic. And so you have a set of incentives where medical directors are not disclosing to patients that by seeking treatment at a particular facility, that nephrologist will personally financially benefit. Next. So in summary, in the dialysis industry, you have a consolidated market that is able to use that market power to drive up commercial rates while at the same time not providing disclosure that may be important to patients and for their own health care benefit, and to health insurance plans regarding financial impact on the market. Next, please. So just in conclusion, wanted to go back to the two bills that we've mentioned that would help to alleviate some of these problems. First is AB 290, Dr. Wood's bill, to remove that financial incentive for providers, whether it is dialysis clinics or others, to steer patients off of a government-sponsored plan or away from a government-sponsored plan and onto a commercial plan that would be more lucrative. And then also SB 343 by Dr. Pan, that is the companion bill to AB 731, that will make sure Kaiser's playing by the same rules as all of the other hospitals and insurance plans. And with that, we'd like to conclude. And if you have any other questions, happy to answer those.
Thank you, John. I actually have a question that I've been thinking about, and if you could give me your perspective, I would greatly appreciate it. So every time and this is about the market consolidation, not necessarily about Kaiser, but in your opinion and experience with these hospital mergers and big health insurance mergers, it's always sold to us as, and when I mean us, the public, and to legislators, is that one, it's going to save consumers money, two, that we're going to streamline services, and three, we're going to improve the quality of care. And I've yet to see that in any of the mergers. Is that what you've seen in terms of this ongoing kind of consolidation of just market share in general? Because they give us these three lines all the time. Mm-hmm. And for me, it's just, I haven't seen it. Have you, what are your thoughts on that?
You're exactly right. Those claims have been dubious at best. For years, we've seen this consolidation, and have not seen that accompanying benefit to consumers or to patients. And there have been a few very interesting studies done in the past few years that looked at that market, at that consolidation. UC Berkeley's Petrus Center did a report this past year that did an excellent job of digging in and really showing, among other things, the geographic difference, and that in Northern California, where you have so much more consolidation, you have much higher prices, even after adjusting for the higher cost of living, than you do in Southern California, where the market is much more competitive. And yes, whether it is the claims of streamlining, whether it is the claims of improved care, that is difficult to document and definitely could use more oversight by regulators and the legislature.
Great. Thank you. Appreciate your testimony.
Thank you for the time.
So we're going to move to public comment. We can take 2 people at a time at the table to testify. And if you want to testify, you can just form a line behind the 2 chairs, or maybe on the sides, whatever's easier. Yeah, maybe on the right-hand side of the room. We're going to limit each speaker to 2 minutes, please. And the two first speakers can come to the table now.
We have a handicap there?
Absolutely.
Okay.
Yeah.
Yes.
Thank you. Can we put the mic up close? Sir? Perfect. Thank you. Go ahead.
Thank you. Good afternoon, Brother Senator. Good to see you, man. Doing a great job.
Full disclosure, Rudy and I used to work together back in the day.
The testimony that I'm about to give may give you a good insight as to the things that are happening. It's amazing to me how that man at Top Kaiser can make $10 million. Wow. My name is Rudy Montalvo, and I pay for my wife's health care. She has an insurance plan through Covered California. When we lived in Los Angeles, we paid a $360 per month for health care. Now we live in Rancho Cucamonga. And for the same plan to Kaiser, we pay $480 for the same health plan. No transparency. It's very difficult living under this situation. We cannot continue to live like this, Brother Senator. Seems like it's getting tougher. And when I made my first appearance at my doctor, I found out that just because I had moved to Rancho Cucamonga in San Bernardino County, my copay doubled. Paying $15 copay in LA County, in Kaiser, and it went up to 30. And everything else, copay, blood test, and all that, went up 40 and $50 just for being in San Bernardino County. That's about it.
Thank you.
Good afternoon, Senator. My name is Raul Romero. I'm a former Vietnam vet, combat vet.
Thank you for your service.
During 1967, I was exposed to Agent Orange. I add that because later on it led to diabetes. I was exposed because of that exposure. The VA contacted me around 1999 that because of the exposure I should come in for a checkup. I had found out I had already had the onset of that disease prior to that and was being treated by a private physician. So I had it pretty much under control. But because of that exposure, I ended up to be a dialysis patient with a number of other issues that went along with the the diabetes, it led on to heart disease, which led on to lung issues, and eventually kidney failure. Just when I thought I was going to make out the hospital with two legs, I caught an infection in my left leg while in the hospital and having an amputation. But the cost and the reason why we're here is I was lucky to be able to afford the $200 that I have to pay for my dialysis treatment. I don't know about everybody else, but it's a difficult stretch once you retire. Retirement isn't for sissies, right? It's a tight income, right? And every penny counts, right? So when my wife and I are the same age, her suffering from a disability, we're in great shape. She pushes me around when I'm around with Brother Rudy. But because of the dialysis center, that's my interest, and I know how it impacts my personal insurance, right? And I can speak on that behalf. I met you many years ago when you were on staff with with Marcos?
Marco, yeah.
Right. I worked for this particular union. God bless. They recruited me and let me come back to be the spokesperson on behalf of dialysis and the people that, because of me recently being elected for 8 years as a water director in the San Gabriel Valley, where I was already well organized, I'm able to speak on healthcare issues, right? At a wide variety of levels, right? I understand your side. I even understand the doctors better. After 3 years of hospitalization, no one gets it better than me. My oldest son is a nurse practitioner, so I get insight from that perspective too, right?
Thank you.
Thank you.
Thank you. And thank you for your service again.
Thank you, Brother Senator.
Thank you.
Chair, please. Okay.
Go ahead first.
All right, thank you. Good afternoon, Mr. Lara, ladies and gentlemen. My name is James Bell, and I'm a 17-year employee for Kaiser Permanente. I have seen Kaiser through the rough years in the first decade of the 21st century when we were not the leaders in healthcare, and I have participated in helping Kaiser become the leader in healthcare it is today. Today, Kaiser is asking for a raise in its rates. This is despite Kaiser, as was stated earlier, they're making $3 billion in profit each year, the last 3 years that I've seen, and they have over $30 billion in profits tucked away in their bank account. They are building facilities all through the state of California and across the country, and are preparing to open a medical school in Pasadena that'll have its first class starting in August of this year. This does not sound like a company to me that is hurting for money. The patients we see are not allowed to know how their money is spent, how much of it's going to cover their care, and how much of it is going to executive compensation. And as we noted before, there's over 24 executives at Kaiser Permanente making over $1 million a year and a CEO making over $10 million a year. And there's too many times in my facility that I've heard patients talking about the cost of their premiums and the high copays they have to pay for the care that I provide, and how they have to make choices about what they are going to pay and what they are not going to pay just to meet the needs of covering the costs of their care. Kaiser constantly short-staffs clinics, which impacts our ability to maximize the care offered to our patients. And at this time, they are facing charges with the National Labor Relations Board for failing to negotiate a contract with the Coalition of Kaiser Permanente unions. Kaiser wants to prevent unions from coming to meetings like this to advocate for our patients. and you'll note a number of unions are not here today to advocate. UNAC, Steelworkers, UFCW have all been silenced by Kaiser Permanente. People who we provide care for every day, while 24 corporate executives receive compensations over $1 million a year, and Kaiser is demanding concessions from caregivers while they are enjoying the best success of this organization's history. As a nonprofit, Kaiser isn't meeting its commitment to our community by only serving about 8% of their entire population. That's all the people they have under Medi-Cal, whereas other healthcare agencies are providing 20% of their membership as Medi-Cal patients. Until Kaiser begins to work in partnership with the community and to provide transparency in its business dealings, I cannot recommend to you to approve any rate increase. And I thank you for your time and consideration.
Thank you. Just want to remind you we have 2 minutes per person. Go ahead.
Good afternoon. My name is Josephine Sarati, and I am a very proud Kaiser patient. I am so sorry to hear all of this. I've been a Kaiser patient for over 40 years. It is overwhelming to think that all of this is actually true. I'm going to go back and do some research because I love Kaiser. Kaiser has been my number one. Why? Because I've been in healthcare for over 34 years. I know other insurance companies that charge a lot of money. However, I never in my wildest dream did I think that Kaiser was taking advantage of us. Never did I think, because I one day wanted to work with them and for them, because I thought that there's nothing better than Kaiser. I promote Kaiser like I promote eating Mexican food. Now that you open my eyes, I just cannot believe that this is happening. Now, and just to go back on the high prices, I'm not going to go through the whole thing because he said everything that I have to say. My son pays over $100 or $400 a premiums to Kaiser. He makes not much money. And not only that, prescriptions and services, emergency, whatever, yes, that is a high cost, but I thought, why not? Blue Cross, Blue Shield, other insurance companies charging just as much. They're making millions and millions of profits. Why not Kaiser? Never did I think that Kaiser was taking almost the whole pie. I want to thank you for letting me to speak today. It opened my eyes. I'm most definitely going to do my homework. Thank you again.
Thank you.
Thank you.
Good afternoon.
Good afternoon.
Thank you
see
for
you again.
listening today. I am a dialysis patient at a DaVita Center. I have been there for 7 years. I have witnessed and seen a lot, but I know we only have 2 minutes, so I'm going to stick to it. And my name is Lorraine Lewis, okay? And I would like to say is that I've been quite ill over the past 7 years, so I've been in the hospital a few times where they've had to do dialysis in the hospital. And I noticed my bill coming home, that my bill was way shorter, way smaller than DaVita's bill for me for 3 days a week, 3 hours a day, okay? Couldn't understand that. And then I started hearing about all the money that DaVita has and makes. And I said, wow. But yet, when I first started with DaVita, we received blankets and coverings for our chairs. They took all of that away because they said it wasn't in their budget anymore. Huh? You know? So I like to know where the money goes to. I would like someone to trail the money, okay? Because let me tell you, DaVita does not spend it on its patients, okay? That I know for a fact. We get nothing extra or nothing beyond, what should I say? Oh, just what they have to do. And that's it. And half the time they don't do what they have to do. Like take your blood pressure every 15 minutes. That's not done. I'm going, huh? Okay, so a lot of things I've heard that they should be doing and they're not doing. But anyway, I've survived 7 years under DaVita. So I'm here to say thank you. Thank you, God. Okay, thank you.
Hi, good afternoon. My name is Alicia, and I'm here as a member of the community and someone who cannot afford to pay the high insurance premiums. Insurance premiums should not be making all the money while laying off workers. I'm diabetic, and I had a heart attack last year, and my medication is very expensive. And it's clear to me that the insurance CEOs are not thinking about patients or people like me. They're just thinking about making money, not thinking about patients. Thank you. That's all I have to say.
Okay,
Thank you.
thank you.
Hi, my name is Adriana Tinoco. I'm with ACIU UHW. I'm here today because I'm diabetic. They changed my medication, and ever since they changed it, I've been hospitalized 3 times already. And also, if I want to buy the correct medication of the replacement, they're charging me $300 a bottle, and that I cannot afford. That's it.
Thank you.
Hi, my name is Ana Marroquin, and I used to have insurance through my husband, but the insurance went so high when he got when the minimum wage went a little bit up. So we decided if we continue paying $300 every month, or I should not get insurance through him, because we had to pay bills and we had to pay rent.
Thank you.
Good afternoon.
Good afternoon.
Mary Grace Barrios. I'm with SEIU 2015. I'm an IHSS provider for my daughter and another consumer. I'm also an e-board member for Region 1 LA County, and I'm the Filipino organizer. I'm alive today because of our healthcare. We have the best doctors in LA County because we have UCLA, USC, doctors dedicated to research, to really care for patients. For 25 years, I was in the health insurance. I'm actually health insurance broker. But I think too much profit in everything. In our schools, in our insurance companies, in our drug companies, in our hospitals, in our housing. I was very fortunate 40 years ago that I lived in Singapore for 2 years, which I think is a model right now in terms of healthcare, wherein the basic needs of healthcare, education, affordable housing, those things that makes our life a quality life. So these things that I see, yes, Kaiser is getting great because why? They're in a model of HMO. So consumers are looking for prices that they can save on. So I don't think it's just Kaiser. I like to see the comparison of all the health insurance companies. Because if you go worldwide, the government in partnership has to play a role. Because if all we look at is for profit, which we see like in the drug companies, I like to see that if we buy, I'm great that this bill that you're pushing through with, and my good friend, Senator Hernandez, who used to be my lawmaker in West Covina, that we can also bargain with drug companies all over the U.S. or even abroad, because we hear of stories of consumers going to Mexico, going to Canada, going to India or wherever to get cheaper drugs. So businesses, they will always base it on competition. So if we have a capability in California, and I love our new governor, who's now fulfilling, his promise, many of us in the unions, that he will really work to make sure that we get quality health care and a quality life in California. And we can do it, we can lead it. But we need to work together. We need to get transparency from everybody and really make sure that we listen to doctors, to nurses who really give the care, all right, and consumers and everybody, because right now we're all seeing parts of the whole pie. By the way, today is my birthday. It's my 64th birthday. And I'm having a second cancer operation tomorrow at Harbor UCLA with the best doctors. Hope I will still be here, to continue this fight with all of you, because I think we deserve better.
You will.
Thank you.
Good luck. Thank you.
Good afternoon. My name is Juan Martinez. I'm a Kaiser member. And I think Kaiser shouldn't be raising rates on people like my parents when they already making so much more than the cost of the care. Every time we run them to the emergency room, our copay is $100 per person. And we have to see that if they can work something on that, because 3 years ago it was $5 a copayment. 4 years ago it was $5 a copayment. Plus the prescriptions. I'm a diabetic also, and generic is the lowest drug pills or medicine you can get. And that's all I have to say about that. Good afternoon.
Thank you.
Hi, my name is Barbara Bondra. This is my son, Michael, and he is 39, and he is doing pretty well. He is at home 24/7, and he is at the developmental level of a preschooler. So as he gets older, he needs increased care of various kinds. He was just they just found out he had plantar fasciitis, and was referred to a foot and ankle clinic who got him the inserts so that he wouldn't be walking on his toes and getting leg cramps anymore. And there was a copay of $200 for those inserts. His disability income is $920 a month. So the fact that he sees 2 or 3 doctors per month makes this, it takes most of his income to pay medical copays. The other thing that I am concerned about is is the fact that like you said, that these insurance companies are allowed to advertise to consumers drugs that consumers can't buy, that have to be prescribed by doctors. And the fact that that is contributing to the high price of drugs is a real concern to me. I do not know why they're allowed to, try to market these to patients, basically. One of the situations that I had with the insurance company that Michael's Medicare came through also was the way that referrals happen. It seems to me that the medical group of the insurance company is in charge of the referrals. And so the process was to go to primary care, get a referral, wait for it to be processed through the medical group, get the name of the doctor, make the appointment, go to the doctor, call the doctor for an appointment, and find out that that doctor's no longer taking patients. Go back to primary care. This is when Michael woke up in the middle of the night and fell down and hit the arm of a chair and broke his nose and had to go to the ER. They said he needs to see an ear, nose, and throat doctor within 2 weeks. And so we started this process of trying to get him an ear, nose, and throat doctor referred through the medical group. He's still never seen one. Okay, it's just, and this is not an isolated incident. So this is a situation, not just a cost situation, but a situation of who has oversight. Who has oversight into these kinds of practices that make the Medicare that we're charging too much copays for practically unavailable to us.
Thank you.
Okay. Thank you.
Thank you.
Good afternoon. I'm Danisha Broden, and I'm a Kaiser Permanente employee. I work in the admitting area, where I receive and process patients' copays, and what some of them have to pay is shocking. For example, on Tuesday, I handled the copays of 28 Kaiser patients. The highest amount was $500, and more than a couple of people paid that much. But that's not even the highest amount. I've seen in my time at Kaiser, I have processed co-payments for a whooping $1,000, $2,000. Yes, you heard me right. $2,000 just for a co-payment. If they are forced to pay that much just to see the doctor, imagine how much their premiums must cost. It's getting out of control, and it's only limiting access to health care. That's why I don't understand how Kaiser CEOs make $10 million a year and how Kaiser justifies raising rates on people who can't afford it. It doesn't make sense. Thank you.
Thank you.
Hi, my name is Eric Gines, and I have been a Kaiser employee for about a decade. I'm also a member of the SEIU, but most importantly, I am a person. And I'm grateful to have the opportunity to be here and for you to listen to us. And I think we, the people, have a large responsibility to the people who are living paycheck to paycheck. I'm doing good, but I work at Kaiser, and I know that I believe that raising premiums is not going to put the pressure where it is, because the people don't have the ability to find a better way to provide health care to our community and to serve our community. So by keeping the financial responsibility on the hospital, we are, and the insurance companies, we are going to be the ones pressured to find a better way to provide affordable health care for our community.
Thank you.
Good afternoon. Thank you for giving us the opportunity to speak. My name is Daniel Romo. I'm a Kaiser employee. I've been with Kaiser for 29 years. And through those 29 years, I have seen our members complain about their card rates, the premiums that they pay. I have actually a family member, my sister, her son has hemophilia. Her premium payment is $2,100 a month. $2,100 a month, $23,000 a year. So unfortunately, by knowing this, I know that Kaiser sits on $30 billion in profits, and also that they have 30 executives that make over $1 million a year. The CEO, Bernard Tyson, makes $10 million a year. So to me, when I'm working for a nonprofit company, I see that it is really unfair, because I do work in a hospital setting. It is unfair to me to know and to hear that. Thank you.
And hello, and again, like my colleague Danny was saying, thank you so much for giving us the time to be heard. And I too am an employee of Kaiser, about 20 years come July, and I've seen us grow from what seemed like a mom and pop shop at the time to this huge healthcare giant. And I think that's my main concern, is that Kaiser is such a huge part of the California insurance market, and given their impact to so many lives of Californians, I think we must make sure that they're good actors to the
Thank you.
community. Thank you.
Pass. Okay. Hello.
Hi.
Good afternoon. My name is Juana Valenzuela, and I'm here. After I hear all those people, believe me, I don't have nothing to say. My insurance went out this year, but thanks God I'm healthy. And I pay, last year I was paying 120, now I pay 140, but what can I say? Just give thanks to God because I'm healthy, and if I had to pay for the insurance, I hear that you said you're gonna work, or we're gonna work together, for better prices, for better things, so I'm gonna be there. That's what I say.
Thank you.
Thank you. Come on, Maria.
Mi nombre es María. Yo estoy aquí porque me fui al doctor y no tenía aseguranza. Me dijo, no la va a poder atender el doctor porque no tiene aseguranza.
My name is Maria, and I'm here today because I went to see the doctor without insurance, and I was told the doctor can't see you if you have no insurance.
Me estaban quitando $500 y yo no sabía por qué. Entonces me fui al social y me dijo, vaya allá, le vamos a dar este papel y se va allá al donde usted va para que le den el medical.
And so I was paying $500 per visit, and it wasn't until somebody told me, go to Social Security offices. I went there, they gave me some paperwork, and they said, go here so that you can apply for Medi-Cal.
Y así pasé. He pasado más de un año que no tengo medical, que no tenía. Hasta hace 2 meses me han dado medical.
And so I spent an entire year without access to Medi-Cal, paying out of pocket, and it wasn't until 2 months ago that I gained access to Medi-Cal.
Y siempre me están quitando. Ahora me están quitando $260.
And right now I'm paying $260.
Y me dijeron, no pida más, que le quiten porque le van a quitar más.
Le dijeron,
y así
no pida
quédese.
más. No pida más. And I was told, don't ask for more, because if you do, they'll just take more money.
Y así me he quedado, que siempre me están quitando dinero.
And so that's my current status. They're still, I'm still paying for this.
Gracias.
Gracias. Thank you.
Gracias.
Hello, my name
Hi,
is
how are you?
Lawana Harris. I'm a Kaiser employee as well for 7 years. I work in patient financial services. I get calls all day from members who cannot afford their insurance premiums, so they're terminated. This is outrageous. They want to increase 5%, but they already can't afford how much it is now. So we're asking you, thank you for being here today and listening, but we're asking for you to partner up and let's get it done.
Thank you.
Hello.
Hi, how are you?
Good, thank you. My name is Janice Richardson. I work at Kaiser Permanente Hospital. I've been working at Kaiser for over 23 years. I am a home health clerk 3. I come here to tell you about Kaiser's greed. I have an inner purpose about Kaiser. I have a sister and a niece that works hard and have families, and they have to pay either their bills or pay for insurance. Kaiser increased their rates every year. They tells me all the time, complains to me, Janice, why do you keep increasing my rates? We work so hard, we have to pay bills and be able to, for our kids to be able to have the health care they need. Kaiser continued to raise its rates despite making $2.5 billion in profits last year. As a nonprofit, why raises rates when they're already making more than enough for patient care? Shame on you, Kaiser. Shame on you.
Thank you.
Thank
you. Do we have any more public comment before we close the comment period? Go ahead.
Hello.
Hi, welcome.
Hi, thank you. My name is Sanji Bobo. I actually work for health in the healthcare field with for Kaiser, and this is just a really crystal clear question to Kaiser, and basically we just would like to know Kaiser need to justify why they are raising the rates. What is Kaiser hiding? Their prices keep going up even though they are laying off nurses, gardeners, call center workers, and parking attendants. Crystal clear, just would like to know that. Thank you.
Thank you.
Good afternoon, Commissioner. My name is Daryl Jerome. I am a 25-year medical assistant with Kaiser Permanente in Orange County. Transparency matters to me. I want to know where my money is going. It is my health care, or is it profits? It's not fair for one healthcare system to have different rules. I need to be able to compare plans and know what I am paying for. I'm also just here to speak on behalf of my patients. As a medical assistant, I hear from my patients that, especially my diabetic patients, that they have to make the decision, especially when it comes to their insulin. And my Medi-Cal patients need to make the decision, what bills do I put off this week or this month in order to be able to afford my insulin or my metformin? Or do I not buy food for my kids in order to buy their medications? And it's not just the premiums. It's, can I afford to take my child into the ER?
Right.
Or can I afford to have my child admitted? Because as you go into the hospital, it's all those hidden costs that you come out of the hospital with that we don't speak about. That as you heard in the prior presentations, where our executives make the $1 million a year, our CEO makes $10+ million a year. I know how much I made. You know how much you made. We're not making anywhere near that. I'm barely surviving. Okay, and I'm a single income family. And so, like I said, I'm here to speak for my patients that don't have a voice.
Thank you.
Okay, so.
Thank you. Do we have any additional comment? This will be our last.
Good afternoon. Thank you for having me. My name is Israel Rodriguez. I work for Environmental Services for Kaiser Permanente, and I'm also an active member of my union. I just want to bring up that, it's a shame that these people are so greedy. I work so hard. I mop their floors. I scrub their toilets. I clean up after the doctors in the OR. The fact that we keep raising prices on these people, these working people just like me, and they do it without shame. We used to have EBS week. We don't have that anymore. The managers, they'd rather pocket that. That is Kaiser greed. With that said, thank you very much.
Thank you. Thank you. I want to just thank the members of the community that are here, thank the SCIU members who have come today to share your stories, to the Kaiser employees and all the other members of the public that have been here. You know, your stories resonate with me. As a lot of you know, I have two parents that were formerly undocumented immigrants, and healthcare to me was something that we didn't have the privilege of having, and healthcare to my family was driving down to Tijuana to get care. And so the stories that you share today hit home. And it's really daunting to see that in our most powerful state, the most richest state in our country, that we continue to not do well for so many Californians that contribute to our economic prowess. And so I'm proud of the work that our governor's doing. Know that we're standing, and I'm standing side by side with him to make sure that we bring more transparency, that we continue to address the issues of lack of care in our community, the skyrocketing prices of the cost of care, and our prescription drug prices, and that we look at quality of care as we continue to evaluate rate increases here in California. And so I just want to take a moment to thank you all for being here. I know you've taken time of your busy schedules to be here, but know that that's the frame and the lens that I look at things too as well. Know that you have a champion and an advocate in this position that has lived a lot of what you have lived. And as somebody, there's nothing like not having care to understand what you have to do to fight to get care for your children, for your loved ones. And I can't even imagine if you even include being undocumented in this country, trying to, coddle together some dollars to find care for you and your children. And that was the reality and continues to be the reality for so many of us here in California. So I want to thank you for your time. I want to thank you for being here. And we are now going to move to the second part of the presentation. I have to catch a flight back up to Sacramento to do people's work. But I want to thank you again for being here and I appreciate your time. Thank you.
Before we begin the next segment, we'll take a brief 2-minute break.
That way anybody who wants to can leave easily.
You have to make everybody accountable. And you should study all the other models. I just came back from Madrid. Wonderful system. My daughter was with me. She had only a $200 bill for ER. She had food poisoning. If you go to an ER now, thousands. It's not right. It's not right. We have to stop.
Thank you very much.
I don't know, you're with Carlos' office, but
Yes.
we're,
Yes.
which department?
We're with the Department of Insurance, with Commissioner Lara.
Which particular?
We're in the health policy.
Just a comment on your presentation. I think you need to make it more like, layman's language. You don't really have to put all the, thank you, technical. I'd like to see the profits that get on Kaiser. Let's make them more transparent. What is really the profit?
There's not a particular deadline if you want to submit something to the department.
And then now they're blaming each other. Commissioner blaming the hospitals. I say yes, we have to have a model of universal health care. What's your signature? Or insurance?
Here we go.
Thank you.
Qualified right now.
And my introduction is basically just
Oh, right. No, that's what we took.
We've had our public meeting.
joint. This one leg, my joints this year start bothering me so cold.
What time's your flight back? I know you're staying now. It's kind of you to return.
What was that?
Okay, we're going to resume with the rest of the meeting here to talk about the large group health insurance rate data that was submitted to the department. So this information is going to be available on our website in terms of the PowerPoint presentation that our chief health actuary and our senior health attorney will be presenting to us right now for folks who want to review it later. Thank you.
And in the interest of time, we're going to omit some introductory information. And we seem to be at that slide here. On slide 33, and our Chief Health Actuary, Lan Brown, will now provide a summary of the large group rate information that we received.
So we have the same 9 insurance companies that submit information to SB 546. So this is for the large group for the insurer market. And the total cover life amounts, the submission is about 644,000 people. And then the 4 insurance companies that dominate this market, about 90% between United, Aetna, Anthem, and Cigna. So between CDI and DMHC, total cover life is about 8.6 million, and we can see that Kaiser definitely have the lion's share in the combined market as close to 60%. So we're going to skip the next 2 slides. It's talking about actuarial the rate development and then how the relating to how the rates are developed, and then go to the slide talking about rating method. So when it's 100% experience rated, that indicated the group itself is has enough membership. The employer group itself has enough membership. That will be experience rated, and then blended is not enough but somewhat large. And then the green portion is the 100% community rated. So just to for comparison purpose, for individual and small group market, and the rates are community rated as required by the ACA. So the next one talking about a product type amongst the submissions, and majority is PPO. And the next one talk about the comparison between 2017 and 2018. This is actually the first year we're seeing the HDHP membership percent. It decreased a little bit from 25% in 2017 to 20% in 2018. In the prior submissions, we've seen a steady increase in the market share in the HDHP plan. Of course, this is a one-year data. We don't know if it's truly the market, the popularities of HDHP is stabilizing, or this is just a glitch, a one-year anomaly. So we'll keep an eye on that for future years. So this is just another chart looking at which carrier offer what type of plans, and just want to note that Cigna and United are the 2 that had more market share membership in HDHP high deductible plans than the other ones. So this one is talking about the actuarial value, which is a measure of the richness of the plans. So compared to the individual and the small group market, the large group plans tend to be offer richer benefits. About 58% of the membership are in plans. It's either sort of equivalent of platinum and gold plans, which means that plan measured by the AV calculator provides 80% or more of the total cost. And I think on the individual and small group, silver tend to be the more popular option. So we can skip this one, just talking about different types of product with different actuarial values. So this is the one, it's measuring the average premium increases year over year on an annual base and average annual claim change on a PMPM base. So the chart actually gives a pretty rosy picture that the increase is very modest. Just want to keep in mind that these are inclusive all type of changes, including the plans changing into a cheaper type of design, as well as employer groups choose to opt into a benefit design that pays less benefit, which will have the effect of reducing the premiums and the claims, but not actually, not actually reducing the total cost, but just making cost shifting to employees. So this is what we require to disclose. Just want to point out the Cover California 2018 average increase of 21.1% is much higher than it was in 2017 and much higher than the 2019 average increase. Part of that increase is because of silver loading for the federal government not funding the cost sharing reduction, as well as the various administrations' various initiatives that created uncertainty in the market, which caused insurance companies to try to price for the uncertainties reflected in the high increases for 2018. This is the average annual increase between 2018 and 2017. The blue one is just the unadjusted, which means it's just total a snapshot of measure. The red bar actually measures the, the red bar measures the normalized. So try to measure the apples to apples comparison. So the red one tend to be higher in most cases. So, and this is the reported increase. We can see the 2018 increase generally higher than what's reported for the 2017 year. And measured by product type, it is also higher for 2018. In 2017, the loss ratio is higher. What's interestingly, the unadjusted loss ratio, which is the blue bar, is higher in 2017 compared to 2016. However, the adjusted one, the red one, is pretty comparable between 2016 and 2017. 2017 was the year that there was actually the fewer fees. There was no ACA insurer fees. And there's also California, there's no California premium tax for the whole year. So, I think that one of the reasons we're seeing 2018 high increases because of the unadjusted loss ratio. However, it seems like the insurance company continue to increase the premium when you look at the unadjusted loss ratio in 2018. So that's, I guess, given that they only required to achieve 85%. So we have seen in the small group market, when they're required to achieve 80%, some of them do aim at 80% and not anything higher. All right. So there's some data, just average premium for the various product. We're going to go through those quickly. Medical trends, and they tend to be pretty high, 7-8% on average, and at the high end, health nav 11%. We also see different categories, and drug is definitely higher than the other service categories. Administrative cost, roughly about 5%. It's pretty consistent if we average all the carriers, all the insurance companies, but with each individual one, it varies significantly. Same thing for commission. It's pretty consistent year from year, but it varies quite a bit amongst the different insurance companies. So this is the administrative cost when we try to look at the U.S. cost versus other OECD countries, which definitely U.S. an outlier at 8%. Everyone else average is 3%. So there are a lot of, there are many papers written about the underlying reasons and various, causations, and the big difference probably the system is being very different here versus the other OECD countries. Healthcare costs is very expensive. Not surprised. We are at about 17%. Average is right around 9%. So almost double. Medicare program, very efficiently run. So this is another look at the data, looking at the post-tax margin. We're looking at post-tax margin for this segment. The market segment is about 4% on average, and it's pretty consistent year over year. And if we look at the dollar amount, that's just another way of looking at it. That's PMPY, per member per year. I think it's per member per month. We'll have to double check on that. I think this is the quality improvement, which is yours. This is the data. We have average. We normally see about 0.8%. This is one of the items that become more prominent under the Affordable Care because they can use it to adjust and increase the adjusted loss ratio in satisfying the federal requirement.
In addition to the data that's presented regarding quality improvement expenses, the SB 546 also required that insurers provide information regarding changes in cost sharing and benefits and their cost containment and quality improvement measures. Each insurer's specific data is available on our website. You'll notice that one of the major cost sharing and benefit change categories, consistent with our discussion earlier today, is attempting to deal with increased drug costs by such thing as rearranging the tiering of the drugs in their formularies. Similarly, insurers have reported savings in avoiding high-cost drugs by changing their formularies. You'll see, for example, on our website that one insurer reported $23.4 million in savings after switching from Harvoni, which was on one of our lists before, an antiviral that treats hepatitis C, for Maravet instead. Similarly, there are other themes that you'll see in the data on our website in terms of a focus on outcomes and safety and other cost reduction measures. That concludes our presentation regarding SB 546. If there's anyone who has any public comment regarding large group rate increases and the factors behind them, we'd be very happy to entertain those now. Seeing none, we'll conclude today's public meeting. Thank you very much.
Thank you very much for coming.
Thank you.